Market volatility is offering buyback opportunities, and many companies are taking advantage of it. Shareholder buybacks were at record levels during the second quarter. Today's ETF Battles is a triple header contest between buyback ETFs from Cambria, Blackrock, and Invesco. So which fund has the superior buyback strategy? Stick around for the answer. I'm Ron DeLegge. This is ETF Battles. Welcome to the program. If you've got a certain ETF contest that you'd like to see, send us your ticker symbols in the comment section below or on our Twitter feed at ETF Guide. Also, if you see an ETF battle suggestion by another viewer that you think makes sense, well, hit the like button for that suggestion, and that'll help us to prioritize the ETF battles that you want to see. Also, don't forget to punch the subscribe button for those of you that have not yet subscribed. That will ensure that you never miss any of our original episodes. So over 1,300 publicly traded companies have reported share repurchases during the second quarter. That was 4% higher compared to the prior quarter. The breadth of buybacks has been continuously increasing for several quarters in a row and is now elevated, reaching its highest level since the first quarter of 2020. Are publicly traded companies using the down market to strategically acquire their own shares at lower prices? Well, actions speak louder than words. And today's ETF battle is a triple header that was requested by Percy Prince and Thomas Beck. Both viewers have been patiently waiting to see today's ETF contest between these buyback ETFs from Cambria, Blackrock, and Invesco. We've got DIVB going up against SYLD versus PKW. Judging today's contest is an illustrious duo. We've got Mike Akins with ETF Action and Tom Psarofagis with Bloomberg. Guys, welcome back.
Good to be here.
Hey, Ron. Nice to see you.
So the four battle categories are cost, exposure strategy, performance, and then we've got our mystery category. That is where you can choose that certain factor, any factor or thing that you think is critical to today's contest. Our judges can also nominate wildcard ETFs if they feel there's better choices elsewhere, or they can opt for split decisions. I've said it before and I'll say it again, the more mayhem per capita that we can have on the show, all the better. I've got the scorekeeping chores. At the end of the program, we'll announce an overall winner. Keep in mind that none of the battle outcomes are ever predetermined or known in advance by myself or our judges. So let's get things started with the first category, cost. Mike, kick it off.
Well, from a headline expense ratio perspective, we have a clear winner in DIVB, which is the iShares product at 25 basis points. But unusual when you have an iShares product, it is not the asset leader or the liquidity leader in this matchup today. So from a total cost perspective, actually PKW is going to have your largest asset base, your largest liquidity. So trading in and out of is going to be cheaper with PKW. SYLD actually spits right in the middle of both, but you have a big range here today. You got 25 basis points all the way up to 64. And I'm here to tell you, don't worry about expense ratio when evaluating these three ETFs because they are very unique. They are very different. And that difference in expense ratio is not going to be the driver of your difference in total returns, which is all that matters in investing is how much did I put in and how much do I get out? So I'm going to give the winner to DIVB because 25 versus an average of 49 for the three ETFs is a big difference, but it's not an important factor for me on today's battle.
Thank you, Mike. Tom, you're up next. How do you see it in terms of cost?
Yeah, well, first of all, great picks by your listener because this is a very interesting category and it's pretty meaty, actually. I think these three ETFs combined have $2 billion or so in assets, so it's a really interesting area of the market. But Mike brought up a great point. You can't argue with DIVB. It's 25 basis points, it's like half the cost of everyone else's. But it's not necessarily the biggest driver, right? So of these three, DIVB actually has the least amount of assets at 200 or so, 250 million. So I think hopefully it's because investors are looking just beyond that and they're allocating to other products. But it's not necessarily just because it's the cheapest, it's going to do the best. But it's hard to argue with 25 bips. It's by far the clear winner here. So it'll be DIVB.
That takes us next to exposure strategy. Tom, you're up. Break it down between these three ETFs.
PKW is probably was the leader in this category. It still is in terms of assets. I think it was really sort of first of its kind when it had come out. And this one's a pretty simple strategy. It just looks at companies' changes in shares outstanding. So who's buying back their stock? That's a pretty simple methodology. DIVB and the Cambria one, SYLD, are actually looking at total shareholder yield. So not only are they looking at buybacks, they're also incorporating a dividend payout ratio as well. So that's the added difference that they have that PKW doesn't. PKW is more just a pure play buyback. The Cambria one takes it a step further, and not only does it look at dividend yield and buybacks, it uses it has value and quality screens added to it, and so it's got a little bit more of a value tilt compared to some of the other ones. They all tend to skew heavy in financials, but if you actually look at sort of factor loadings, SYLD, the Cambria one, has a higher tilt towards some of the value stocks. So that's the key differentiator. That they're all. So everyone just sort of goes a level deeper, but the real kick, the one that I like the most is I like SYLD's sort of added metrics of value, low leverage, quality. I think that sort of takes a step beyond. So for exposure, I like SYLD.
Mike, you're up next. How do you see it in terms of exposure strategy? Do you agree with Tom's analysis?
Yeah, mostly. I think if you look at the way you go about achieving shareholder yield or dividend buybacks, two different metrics, right? Shareholder yield is going to take all factors of distributions to its shareholders, whereas buybacks are purely the companies, purchasing back and reducing their shares outstanding in the market. I would say PKW and DIVB are more pure play buyback strategies, and as Tom, astutely pointed out, SYLD I would think is more of a multi-factor strategy, but it leads with that first screen of looking at shareholder yield. To that extent, there's going to be a lot of similarities in what they achieve in the fundamental perspective. You're going to have above average yields. You're going to have below average valuations at varying degrees, right? SYLD by far and away, as Tom pointed out, has the biggest value characteristics, and it's paid off in the last year, not surprisingly. But they're very similar from an overall characteristics perspective. They get much different when you start looking at composition of size and sectors, right? So starting with sectors, PKW and SYLD have some pretty large skews relative to the broad-based benchmark, call it the S&P 500, whereas DIVB, and I'm not sure if this is by design, I wouldn't be surprised since it's an iShares product, has much tighter allocations relative to the sector breakdown. And then from a market capitalization perspective, SYLD is more of a total market play. It's actually got a higher allocation to mid caps than it does large caps. So it's a true total market, goes down market a little bit more. Put all that together. What do I like right now from an exposure strategy perspective? I continue to like value. I continue to like to be underweight some of the sensitive sectors. From that perspective, SYLD sets up pretty nicely in this environment, and I think that is achieving the exposure I like. Plus, I like the concept of the multi-factor. It's one thing to just do pure play, but if you think about this strategy, it's more designed to be a core holding, and I like that additional screening that goes on, and it's an actively managed product, though it follows a very quantitative process. So SYLD is my winner, and that was a little long, so I apologize.
No worries. You have as long as you want, regardless of that shot clock, which continues to be unenforced. I got to talk to somebody about that.
Yeah, unlike the MBA in college, let's extend our shot clock a little bit. Like let's be contrarians in that standpoint.
I'm with you. All right, let's shift to performance. Mike, you still have the floor, so give us your analysis between these three funds.
All right. Well, I mean, wow, you're talking about a huge spread here in divergence of returns. Not just on the, it's actually funny, it's the closest really is, well, the last couple of months, it's been pretty close. Market's been pretty correlated. But if you look at the 1, 3, and 5-year only exists for PKW and SYLD. DIVB does not have a 5-year track record. But there's huge divergence. SYLD, by far and away, on a past performance perspective, is crushing the market. It's down, 1.6% on the 1 year versus 5.8 on DIVB and 10.9 on PKW. PKW and DIVB bunch up on the 3-year, but SYLD is at 18.86, a full 8% above either one of those products. So, part of that is it's got that deep value tilt, and it's really ran with that. But I think, it's got a long enough track record where it's showed very consistent returns, not just to these two competitors, but to the basically free overall by the market ETFs out there. So it's delivering it's delivering an added value to a portfolio. So I like SYLD on a performance perspective. And as I already said in the previous segment on exposure, I like the characteristics of this portfolio, both sector exposure and that deep value kind of construct that it currently has. So for me, it's pretty easy on the performance. It's SYLD every day of the week and twice on Sunday.
All right. And 3 times on Monday. Thank you very much, Mike. You're up next, Tom. How do you see things when it comes to performance? Do you agree with Mike's analysis?
Yeah, it's hard to disagree because, like you pointed out, it's not even close on the 1 and 3 year. SYLD really has a big advantage. It also punches out a little bit of a higher yield too, so that's the sort of really two attractive things that are in its favor. But it goes back to a thing we were even talking about cost, right? Like SYLD is 59 versus DIVB, which is 25. This performance spread more than overshadows that performance difference. So that's why it's really important to not just like if I pick the cheapest one, it can easily get overshadowed by performance. But, another thing that Mike said that really stuck out was just sort of pure play. And maybe because of this value characteristic and the high value loading, it's important to know like what's driving the performance, right? Is it really the buybacks driving it, or is it because of this value tilt? So I think that's, even though it's helped, it's really important to know that, let's say if you were to run an attribution, is it not really the buyback portion of it that's leading? So it's important to know how these things are constructed, because you had a good point. PKW is sort of your pure play buyback ETF. It's got very low overlap. So does SYLD. Very concentrated portfolios. DIVB has pretty high overlap with the S&P. So it's important to know that, okay, yeah, SYLD is outperforming, but is it because of the buyback? So it's really important to look at attribution. But it's just so happening that this multi-factor approach is helping it on performance. So it's hard to argue with it. SYLD gets the performance vote for sure, and because of these value characteristics that it has.
Let's move on to the mystery battle category. This is where our judges can pick that single factor or multiple factors that they feel is crucial to today's triple header. So, Tom, you're up. What is your mystery battle category and who wins it?
I sort of alluded to it, but it was a dividend yield a little bit, and it does get cranked out a little. They're all pretty good, but SYLD now has over 2%, which the other two don't. At least what I'm showing. So it's got that real nice dividend kicker as well that you're not getting with some of the other ones. I want to just do an honorable mention. I don't want to replace any tickers, but we often get questions on buybacks, and it's usually the opposite. It's like, well, okay, you have companies that are spending on buybacks, but what about like CapEx, right? Or companies investing in R&D. Now, historically, there's never been an ETF on that, but there's a new one that launched pretty recently from Index IQ. It's LRND, so it's the US R&D ETF. It's really new. I don't want to replace it with the buyback, but if you're interested in something on the opposite side, so companies that are investing in R&D or CapEx, it's one to look at. So I don't know, if you have an honorable mention category, but I would throw that in there. It's just something to look at. It's pretty new. It's a sort of first of its kind ETF. So something to keep in mind when you're looking alongside the buyback story.
We do not have an honorable mention category. Well, actually, we do. Now that you've mentioned it, we just added it right now.
Is it new? Is it the birth of it now?
Yeah. So for most of the history of this show, we've had a wild card category, but honorable mention is a new one. Which would probably I don't know. It's a good category though. Thank you for mentioning it, and I think again we'll have to. We'll have to add it at least for this particular battle. So we've got LRND is a ticker, correct?
Correct.
Okay, very good. And we'll take this to our viewers. If you see any other ETFs that you'd like to go up against our LRND, let us know. Like Tom said, it is a new ticker, so it doesn't have much of a performance history, but it is on our radar. Thank you, Tom, for bringing that to our attention. So, Mike, you're up next. Your mystery battle category, what is it, and which of these three ETFs wins it?
Oh my, I got a treat. I got two mystery categories. One I promise is going to be really fast. On the pure side of buybacks, just to throw it out there, I mean, it's going to be interesting to see with the new IRA, wonderful name, act that we have out there in the marketplace, the Inflation Reduction Act, and how it is handling corporate taxes. There's a little mention in there about buybacks and a 1% tax levy on potential tax levy on corporations that do buybacks. It'll be interesting to see what that, if that actually goes through and everything happens, what dynamic that plays out long term as far as companies doing buybacks. That drag to the concept. Neither here nor there. Smarter people than I will write about it and talk about it, but just something to keep an eye on. My real mystery category, the one I wanted to spend a little time on, Tom alluded to in his previous section talking about overlap. And I think talking about pure play versus non-pure play this is a great category to do it. Using our overlap analysis tool on our site, I just typed in PKW, SYLD, and DIVB, and then SPY, throw in that S&P 500 component. And Tom mentioned this. DIVB has got 297 names and 67.2% overlap with the S&P 500. This is like very high correlation, low tracking error, core kind of concept. Hey, I like the idea of it, but I'm going to replace my core because if you're using it in conjunction with, you're not getting much change. SYLD and PKW, on the other hand, SYLD has 40 names and 4.2% overlap. PKW has 42 names and 4.5% overlap with the S&P 500. Very, very different. Their returns are going to be driven by their selection process, whether that's passive or active, multi-factor or single factor. The simple reality is you look under the hood, it is not an index hugger. It's a unique strategy that can be used as a core product or a satellite product, or it's something that's a deep value construct. It could be replaced with your favorite higher growth product. But when I think of it from a metric I like to track is if you take the expense ratio of a product, take it times its overlap or active share relative to a broad benchmark, you can kind of put a per unit concept to it. So while if you look at SYLD, it's more expensive than DIVB, you're also getting a much different portfolio, which means the expense ratio has much less importance. And that's something I think is a great opportunity with this battle in particular to point out that difference. And Tom tried to steal a little bit of my thunder, but I think I got it back there at the end. And so my mystery category is thinking about concentration, the purity of the strategy, neither good or bad. Like there's good reasons to have not less pure and more pure, depends on how you're using them. But it's a good example of the importance of understanding that. Again, when it's all said and done, SYLD is still my winner.
Okay, perfect. I got you down for SYLD on your mystery battle category. And by the way, that tool that you mentioned, available at etfaction.com. Do go there. Do check it out. And Mike and his team have been working very hard. I know they did some recent upgrades to the tool. So again, be sure to check that out. It's an awesome tool. So let's give our judges a final opportunity to weigh in with their overall battle winner. Mike, give it to us.
Yeah, today it's going to be SYLD for a number of factors. I do like the multi-factor approach. They lead with their principle, which is that kind of buyback shareholder yield concept, but then they apply some additional screens and then kind of got an active tilt to it. Just in general, I like their process. But then number two, I'm always thinking about what are the markets today and where do I want to be? I like their value construct. I like their sector allocations. So it's just a timely opportunity for me to have a clear-cut winner, and that is SYLD.
Tom, your final chance to weigh in with your overall battle winner.
I agree. I'm not going to put up much of a fight. I think the performance of it is runs away. SYLD is a clear winner here. And like Mike mentioned, the current environment, I like those extra screens that it has, low leverage, the financial, the value tilt. So I think it's very conducive for what's happening right now in the market. And, the ETF industry is competitive. It's nice to see a smaller issuer, take one. It's tough going up against iShares and Invesco. And so it's sort of like when you see a smaller a product from one of the smaller issuers stand out. So SYLD is my winner.
Well, thank you, judges, for your Excellent analysis, and according to my battle scorecard, this is a win for Cambria, ticker symbol SYLD. Our judges in the end agreeing that this particular ETF stood out. Of course, it has a higher tilt toward those value stocks. It leans towards those mid caps. And even though it's less of a pure play on buybacks as the other counterparts in this particular contest, it does, again, deliver when it comes to historical performance. It's done that. It also, as Tom pointed out, has a slightly better yield. And I guess some of the key takeaways from this battle is just because an ETF is the cheapest or the lowest cost doesn't necessarily make it the best. And today's ETF battle proves that. Also, the other thing that jumped out to me was the correlations to the S&P 500, DIVB having the highest correlation. So my goodness, if you're combining DIVB with an existing position in an S&P 500 ETF, you're getting what's called over-diversification, more of the same. And it's something that, again, our judges brought to light. And overall, Mike and Tom, outstanding job with today's analysis, today's ETF buyback showdown. Keep up the good work.
Thanks, Ron. It's great to see you, Tom.
Likewise. Thanks, guys.
Be sure to visit the description section below. We've got research links to our judges, so get in touch with them. And while you're there, check out the link to our program sponsor, Direction Investments. You'll also see viewer resources from us. We've got our margin of safety tool waiting list, so be sure to join that. Which ETF battles would you like to see in our next episode? Post your ticker symbols in our YouTube comment section below or on our Twitter feed @ETF Guide. I'm Ron DeLegge. Thanks for watching. We'll see you next time.